Did you watch any of the funeral?
I mean, it was on.
It was a weird day today to be in the office, but the stock market's closed. Is this how normal people live?
I wondered that today.
Right?
I was
Isn't
like,
it so weird?
I could have meetings. And indeed, a lot of people in my office were having meetings today.
Do you know how many times I refreshed the ticker page?
Did you?
I can't help it. It's a force of habit. Like what's going on with my life?
It felt luxurious to me. Because Thursday's my writing day. I write our morning brief newsletter on Thursdays for Friday. Okay. And usually I have to do that like in between other things.
Right.
I've even been known to finish it like during the show, during commercial breaks.
So you had no shows to make today, so you could just write.
Today.
What's the topic du jour?
Well, we're going to get to it. We're going to get to it.
Should I tease it? Should I do a tease? What we call in the biz?
Yeah. Do a tease.
Bond yields. Yields in the
bond yields. Are they good?
It depends.
We'll find out.
It depends.
Where do they fit into your diet?
Will bond yields fit into your diet? Stick around. So I watched a little bit of it. They had Joe Biden gave a speech, which I thought was pretty good. And it sort of was like a subtweet about Donald Trump because the whole thing was about Jimmy Carter's character and why character matters. Because I think that's the thing. Like if you ask somebody what they think of Jimmy Carter, that's like probably the main thing people point to.
Good guy.
Is how modest he is. And
I never met him.
Never met him. He's sort of like the anti-Trump. He still lives in this like Ranger Ranch style house.
Lived a life of service, right?
So you want to laugh? He had to sell his business to become the president. It was
quaint.
It was a peanut farm.
Yeah.
Right. Yeah.
Okay. I think that precedent.
Think about the conflicts.
Yeah. Can you imagine the conflicts? I think that precedent is over forever.
Well, today he would be forced to putting the peanut farm in a blind trust.
He would have to sell peanuts from the White House.
I don't know.
Yeah. I don't think any president will ever really have to do that again, which opens up the window to more types of presidents who want to keep their business. How could you tell them they can't?
There's an argument to be made that like, hey, you've spent 30, 40 years of your life building a business, some enterprise, and you got to divest yourself of it. Like it was Mitt Romney that was going hard into that point.
I think you limit the well of potential people that you might want to run the country.
Yes.
If you're going to make them all sell their businesses.
Can we talk about the election of 2028?
Yeah.
Who do you got?
Who are you voting for? Gavin Newsom or Donald Trump Jr.? What do you think?
Elon Musk.
You going to vote for?
He can't run. Are we changing the law so that he can run?
Yeah.
Probably.
Okay. Well, you got Trump in office. We can do whatever we want now.
If he's from Greenland by then, it'll be the 51st state.
You know who the most famous person from Greenland is?
Tell me.
I don't know. It's got to be someone.
I'm gonna look it up right now.
I don't know.
Guys, we ready?
It does have to be someone.
I'm out of banter.
Some of the worst banter you've honestly ever done.
Listen.
I'm looking forward to the election of 2028.
I don't know what to tell you. I'm out.
And do you know who's the most famous person from Greenland?
Listen.
Did
you get a home run?
Did you find it?
Yeah, no one I recognize.
Today's show is brought to you by Van Eck. Listen up. There is a huge wave of demand currently and on the horizon from hyperscalers for data center power. And many of them have already looked to nuclear as a solution in the short to intermediate term. Why? Because it is both clean and efficient. It has one of the lowest emission profiles among energy sources, and it can produce power 24/7, unlike renewable sources that produce electricity intermittently. To learn more about getting your exposure to these companies, visit vaneck.com/NLR. That's vaneck.com/NLR.
All right, ladies and gentlemen, welcome. Welcome to episode 173. All right. You are now rocking with the best investing podcast you've ever heard in your entire life. I stake my whole reputation on that. Doug, what do you think?
Yeah, you should do that.
You listen to a lot of investing podcasts, though?
Just this one.
Just this one. See? Told you.
And Michael's. And Michael's.
Guys, we are doubly blessed today. We have two of my favorite people. One is a repeat guest, longtime friend of the show, and one is her first appearance ever.
Amazing.
Hopefully not the last. Allow me to introduce you to Julie Hyman. Julie is a host for Yahoo Finance Live. Julie has been a financial journalist for more than 20 years, covering events including the Great Financial Crisis.
That doesn't deserve an applause. Come on.
The collapse of drug maker Valiant, I remember.
Yeah.
And the rise of the meme stocks. Before joining Yahoo Finance in 2018, Julie worked at Bloomberg Television as a senior markets correspondent, anchor, and retail reporter. That's where I met you.
Yes.
Yes. Those were the
there for a
days.
long
In many
time.
ways, those were the days.
Were those the days?
I sort of feel like they were.
In what way were those the days?
I'm not sure.
I feel like everybody's all about 90s nostalgia right now.
Yes.
Yeah, that's a thing this
Yes.
week that's going on.
But like, what year was it?
I probably,
Post-financial
I'm
crisis.
going to guess that I met you in like 2010, 2011. I was
okay.
doing a lot of Bloomberg back then. Most people don't know that about me. I was doing that show that Matt was doing at like 11 o'clock at night. What was that? What was that show on Bloomberg?
I mean, there were so many different. You mean
Matt
Miller?
Miller.
Yeah.
Yeah. What was he doing? It was weird. It was great.
If it was Miller, it was weird.
He's so weird. I love that guy.
He's amazing.
So I was doing a lot of Bloomberg radio. I even co-hosted the radio, and I did a bunch of Bloomberg TV.
Nice.
So I'm guessing I would have met you around that time, 2011-ish.
2011 was a good time.
Yeah, it was a wild time. With us also today, Doug Boneparth. Doug is the president and founder of Ritholtz Wealth, an independent RIA focused on serving high-achieving millennials. Along with his wife, Heather, he is also the co-author of Money Together, their forthcoming book on love and money.
When is it forthcoming?
When is it coming out? I feel like
We have a
talking about
publication
it.
date as of like 2 days ago. It's October 28th.
Are you
2026?
It's a
Are you on
Tuesday.
pre-sale? Are you available for pre-sale right now?
I technically think you can pre-order this right now.
Okay.
I wasn't prepared to say that to anyone, but yeah.
Oh, okay. Give us like the elevator pitch. Why should people buy the book?
Because in our lives, you're a team with your partner, and money is never not going to be a thing that you have to deal with. It's not a game you can win. It's going to evolve. It's going to change. It's cliche to mention the statistic of how many relationships don't work out because of money.
Yeah,
Let's
most.
fix, let's
My first wife.
yeah, let's fix that. Let's make this possible to communicate around the things that make a strong and unstoppable financial team.
What's the writing process like with any, not just your wife, but any partner? You switch off chapters?
Don't
or?
get divorced is the number one thing.
No.
of that
What's the process though? Like,
Yeah.
who does what?
We did this in Heather's voice. She's the better writer. So there are over 75 interviews of couples, over 35 interviews with professionals and experts in their respective fields. So while I'm out there getting interviews and sitting in those interviews and coming up with, collaborating with the ideas that we have, we're going to use her voice. We're going to use her writing style because she's a prolific writer and everyone's going to see that.
Did you guys turn the mics on yourselves?
Yes, we weave our story throughout the entire book. But I have to tell you, the people we've interviewed, I cried twice reading this book. There are some really exceptional stories that are relatable to any reader. I'm so privileged to talk to those individuals.
I love this. Very exciting. Most investing and money books are geared toward, I know you know this, are geared specifically toward an individual reader. This sounds like something that, like, let's buy 2 copies and then talk about it.
You are going to read this book and grab your spouse and say,
Read this part.
This is us. Like, this is us.
All right,
like
love
Eve Rodsky did that with Fair Play. You're gonna do that here with money.
All right, we're very excited for you, Doug.
Thank you.
Of course, we will include a link to where people can see the book for pre-order. So can we talk about rising 10-year yields? Julie, you wrote about this.
I did. Yeah.
All right. We're front running your piece a little bit.
You are. Well, but by the time this comes,
It'll be fun.
Okay. It'll come out Friday morning. So, I mean, and I'm certainly not the only person to notice this, right? Like, we've seen stocks pull back since mid-December at the same time that yields on the 10-year have gone up by like 50 basis points, right? So the question is, why is it a problem? Because yields went up other times, especially last year, and it didn't seem to be a problem for stocks. And at the time, everybody was saying to us in interviews, well, it matters why yields are going up, right? And if yields are going up because people are optimistic about the economy, then it's not as much a problem. But yields kept going up even when the Fed was cutting, which seemed to be puzzling everybody also. And now yields are going up and inflation seems to be coming back. And that is not making people as happy as it was, when that wasn't the case.
Can I quote you?
Sure.
Okay, I'm going to quote
I
you.
don't know if I've ever been quoted it myself.
I'm going to quote you quoting others. There's debate over what level in the 10-year yield would be especially problematic for stocks, with consensus coalescing around 5%. And markets have already gotten a taste of that. The less closely watched 20-year Treasury hit 5% this week. Yields notwithstanding, most Wall Street strategists,
Uri and
I know you
Timmer from
talked to
Fidelity,
Uri,
yeah.
friend of the show as well, and Michael Arone from State Street think that earnings, not fiscal policy, not the Fed, will determine where stocks go. Okay, sure, but 5% is going to get people to sell. And I don't know 100% why that's the case. I just know that it's true. You got a take on that?
I want to see if it blasts through it. I think that's what gets people really spooked here.
So not stopping at 5.
Yeah, the momentum into it. Like if we hit it and we flail around there and we come down a little bit, we'll be like, oh, that's like April, or oh, that's like October of 23. Maybe earnings will come through and we'll see rosier pastures. But if it blows through it.
You think you're going to have clients ask you, hey, does it make sense to take a little bit less risk?
I think clients are going to be wondering how long duration, they should have been or need to be moving forward on their fixed income portfolios.
Well, cash is over.
Yeah.
Well, so that's the reason people sell. People don't sell stocks at a 5% 10-year for no reason because they think it's like some unwritten rule it's because it's a competing asset class and it's guaranteed. So if you think you're going to do worse than 5% in the stock market this year, then that's a really easy trade-off to make. Even though bonds are also total return, but like that's the reason why that could be a threat to the bull market kind of thing. What else did Urian say when you talked to him?
So he talked about inflation too and being a little bit concerned about inflation, but overall he is bullish. I mean, he also talked about the, sort of the term premium on treasuries versus stocks and sort of the competition that you're talking about to some extent. He still likes Bitcoin because he's like that for a while.
In a 5% yield environment.
I think he likes it regardless of anything else, which is mostly the case when people like it. But he also is fairly optimistic about earnings growth, regardless of what happens. Excluding that, and that's kind of been consensus-ish of people that we've been talking to lately, is that they are pretty optimistic about earnings. And it's always interesting to me when somebody says, well, don't pay attention to the Fed, don't pay attention to fiscal policy, because those things obviously could have some impact on some earnings. I think the view is just that it won't be widespread enough to
more of an
really
impact on
depress them.
sentiment than on earnings, at least in the short term.
Yeah, I think that's fair.
One of the big stories this week is about you mentioned the term premium, and I wanted to just bring this up because if we think that the reason why the 10-year yield matters is the why it's rising. So this is one of the puzzles on the street, and Bloomberg wrote about this today. I'll quote Bloomberg. It's the buzzword on Wall Street and in the hallways of the Federal Reserve and Treasury Department. It's blamed for triggering bond sell-offs, shifts in debt auctions, and interest rate policy. Few agree on exactly what it reflects or how to measure it. It doesn't matter. The term premium is a powerful new force in the market. And the gist of this is it's the portion of the yield that's unexplained by inflation expectations. There's something else going on there. And maybe that's financial risk generally, or maybe that's risk specific to U.S. debt, or maybe that's concerns about President-elect Trump's new policies.
Right.
But like that term premium, Bloomberg calls it the dark matter of Wall Street. And the reason why is they asked a bunch of people to measure it or explain it, and they got a wild array of different measurements and different explanations. We have a chart. Let me show you this. This is Bloomberg's chart. So this is the term premium itself, and it got up to almost 0.5%, which in bond yield terms is sort of a big deal. Backed off a little bit, but it's not zero and it's not below zero anymore. Right. So we had negative term premium for a while. Now we have positive term premium, and this is what people are talking about on the street.
So we have the largest unexplainable premium.
Well, we'll find out the reason later. That's how.
Stay tuned.
If I could chime in with one more reason, maybe, but I don't necessarily agree with this reason, but it's something that someone said to me recently. John Hilsenrath, who you guys probably remember as like the Fed whisperer at the
Fed
Journal.
Roach.
Where the hell did that guy go?
He's consulting
company,
now.
right?
Yeah, he's consulting
okay.
now. And so he was on with us the other day, and while we were on, we were talking about Fed minutes. And then after we went off, he said, I want, next time we got to talk more about yields. He thinks maybe there's a little more bond vigilantism creeping back in the market. I don't know that I buy that yet. I mean, I talked to Rick Reeder last year, and he said markets pay attention to the shark closest to the boat, and the deficits are not the shark closest to the boat right now.
What is the shark?
Inflation.
Yeah, I don't know what he would even think the shark is at this moment because he's bullish. But I mean,
that's the Fed. The Fed's shark is not whether or not people are going to boycott U.S. bonds because of our national debt.
Well,
the Fed's shark is still inflation.
If there was concerns over our deficit and debt, and maybe that's showing up in the strength of gold and Bitcoin, but it would show up in dollar weakness. And that's not happening clearly.
Right.
The dollar has been in a secular bull market for a long time.
Exactly. So I don't know that this is happening yet, but it is. I mean, certainly people were talking about it a lot around the election. And there was another interesting note out from Jason Drayo over at UBS, who I think we're talking to tomorrow, who talked about MAGA versus Doge. In other words, the different impulses in the administration cutting versus spending.
Yeah. And
what is that going to do to deficits? So I think, I don't know that it's being felt in the markets that tangibly right now, but we're going to be talking about this for the next 4 years.
I think it's just an expression of people saying this is not as low risk as you think it is to be in the bond market or to be in cash. I don't think that anyone thinks that we're going to get this surge of bond vigilantism and people are going to dump their treasuries. I don't know that whatever I just showed you would represent enough fear to say that.
I think to Michael's point, it's
yeah. But
I also think this is good.
Dramatic.
It's generally a good thing. How long did we bemoan the fact that investors or savers were being punished? And now nobody's saying they're being rewarded, but they are.
Yeah.
Because it is a much better environment.
You can get some good yield, and perhaps, if you still believe rates are going to come down, there's your appreciation while you wait. I mean, that's kind of where I've been hoping to get.
We're there.
But we've been kind of robbed of it as rates are we're not getting the appreciation on the bonds you bought, more cheaply.
Remember bond
we're going
proxies?
back up now.
Remember bond proxies in 2013, 14? It was preferred stocks. It was junk bonds. It was AT&T dividends. Now we don't need proxies. We have actual bonds. I think it's a great thing.
I think what's really happening, the Fed is no longer punishing savers. They're punishing realtors.
That's one way to put it.
I mean, that's literally who's paying the price for this for the last 2 years. We just had 4 rate cuts last year, and the 10-year went up 100 basis points. And nowhere is that felt more acutely than somebody trying to get people to take out a mortgage and buy a house.
And just last month, you were told you're not getting half as many rate cuts,
Look at
this year as you were.
So this chart shows the 10-year yield before and after the first Fed cut.
Yeah.
And
crazy.
Normally, obviously, when the Fed is cutting, the long end goes down too. And this is the exact opposite. Just a very unusual.
Did you guys see the latest mortgage rates?
Was 7.2?
Yeah, it's crazy.
6.93. The Fannie and Freddie.
That was my joke yesterday.
Nice.
It's the highest since July.
Now that rates have come down, I'm excited I can refinance my 6.5% mortgage at 7%.
Congratulations to you.
Thank you.
So I spoke to somebody who's been a realtor for 25 years this week. He said he sold one house this year.
Oof.
One house.
Not good.
And where he is located, there is no new construction. It's just turning over houses, and houses aren't turning. And then I spoke to a mortgage broker I'm friendly with, and this is fire and brimstone. He's just like, I don't understand what's going on. We just got 4 rate hikes. Why won't Wall Street let us have the rate hikes? Why are they putting the rates back up? And I don't really have a great answer for him because we did get to 2.5% inflation. So for whatever reason, it's not working the way they thought. The real estate market is as frozen as I think it's been that we can remember.
How long can we keep pointing to lack of supply as the largest explanation or the larger
It is,
explanation?
though.
As long as it exists. It's the
As
truth.
long as it exists.
And that's for the foreseeable future. I don't understand how we're going to build and construct.
We were
that.
we were saying, Michael, you and I 2 days ago, or yesterday, if all this AI spending stuff wasn't going on and the market was conforming more to the housing cycle, which is what it normally does, we would be 0% GDP. Stock market.
I think the S&P would be at 4,000.
Yeah, I think the stock market would be at least 15-20% lower. So I think it's not great. Let's go into, but we are still in a bull market. Let's go into some of these charts. We're in the 3rd year now of a bull market. And I don't know, what are the ramifications here?
So it just gets a little bit dicier. Year 3 does, then years 1 and 2. I guess just by definition, we've got this chart from Todd Sohn showing all of the different paths, and there's not a million of them, but nevertheless, the dispersion is pretty notable. There's nothing here whatsoever other than a lot of spaghetti on a chart.
What's the red line?
That's the average.
The median.
That's median.
That's the median. That's what year 3 of a bull market looks like.
Yeah.
It doesn't look that great.
Listen, I would take this. I'd sign up for this.
Yeah.
If we can get back-to-back 20% years in a sideways year, who says no?
Not many.
I think
Take a breather.
I think most people would sign on for 20 what do we have? 24, 27 flat.
I mean, listen, I think that stocks going up 20% year after year sets yourself up for something dangerous. Like, to me, this would be very healthy and welcomed.
A return to normalcy.
Let's go to the next one.
So 2024 was interesting in the sense that it was a complete continuation of 2023. Also from Todd Stone, what we're looking at is the top 10 contribution or contributing stocks as a percentage of the overall total. So the record year was 2007. The second record was 2023, where around 69% of the returns came from only 10 stocks. And then you saw a repeat of that in 2024. And on the flip side, stocks that sucked wind in 2023 also sucked ass in 2024, which is an
Didn't have the
unusual
normal
dynamic.
rotation.
That's a technical term.
Yeah. Sucked wind to sucked ass. That's how we do it.
When you talk to people, is this one of the things that people bring up the most?
They say suck went to suck.
No. Like the concentration or
No, of course. They talk about concentration all the time. And they keep saying the broadening is coming, just like they keep saying small caps are going to start to do better.
Do you know why?
And neither thing has happened.
Because that's what they're selling.
Right,
They're
clearly.
selling a strategy that differs from the index.
Well,
they have to believe that.
Well, and what's so funny to me about this argument is like, things need to broaden. Why do they need to broaden?
So that they can sell value.
Right, but I'm saying
they could sell large cap value, they could
like,
sell-
to keep the rally going, things have to broaden. Well, no, they don't.
Well, they haven't.
Right.
Or they broaden temporarily and then narrow. And the rally keeps going.
But as long as, and I also keep seeing these charts like, the Mag 7 growth is going to their earnings growth is going to decelerate a little bit and everything else is going to accelerate a little bit, but there's still a big gulf between the two. As long as the Mag 7 growth is still happening, why can't they continue to lead the market?
This coming year is another year where the Mag 7 is going to out-earn the rest of the market, I think by a lesser degree.
Yes.
But still.
I mean, look, for your classic 60-40 investors or 80-20 investors where you have that 12% allocation to mid caps or 7 to small caps, right? It's kind of starting to have interesting conversations with clients or, what do we have these mid caps and small caps?
Yeah, what do these even do? I don't understand.
And we have to say, you're going to be glad that they're there when you're unhappy with momentum and large growth. And you pull out your Ibbotson chart and you go back 2 decades to where that is. And you have to believe in stats and believe in, long periods of time and constantly remind your clients. It's just now becoming that conversation when you're looking at your your risk-adjusted portfolios.
It does feel like we've reached a critical point of it feels like people think that the past is going to continue indefinitely.
Well, we almost had it, right? You saw the broadening happen. It started to that rally in the end of September.
October.
Yeah, it was there. I was stoked. I was like, this is
finally
the bull market of bull markets now. Like everything's firing on all cylinders. And we retreated from that.
Small caps gave up their entire post-election pop.
Yep.
Like gone.
All-time high. We had all-time highs.
All of it.
Some of these things just work better tactically than long term. Like there's room to say you could have a period of time where small caps lead large caps. Should you think that could be a 10-year period of time? I don't think anyone should think that.
Really?
I just don't.
Come on.
Do you think anyone believes that?
Yeah.
You think there are people that believe small caps?
So now all of a sudden you think diversification is stupid?
No. I don't. I think they work better tactically than they work strategically because of how hard it is.
Literally recency bias talking.
I know.
Come on.
But recently, that's how I feel. It's hard. All right. Somebody's like, why do I own international stocks? Well, that's very simple. It's to make small and mid caps look good. So there's a purpose for everything in a portfolio. I would just say it's really hard for people to picture right now a situation where you have an over 10-year period.
Not for me, it's not.
Of small
Listen,
cap
the CAPE ratio is
outperformance.
37. It's 37. It's high. Even if you look at forward earnings estimates, especially for the Mag 7, it's high. It's very easy for me to picture a world where this doesn't persist. I'm not saying it's going to stop today or tomorrow, but if you think out beyond the next 12 to 24 months, I could easily see a scenario where the rest of the world doesn't look as bad as it has been in the last 10 years.
When your client needs a 6 or 7% average return to solve their retirement planning scenarios, and they're getting 13 to 17% on their 80-20 or 60-40, take your pick. And that includes them holding mid caps and small caps.
Right.
Are they going to feel good knowing that, the story of you're going to be happy that they're here for the times when, the AI story or the growth story is not there, I think is worth it. I really do. They're outperforming what they need to get to retirement at 55.
Hold on. Think about in 2022 if you were saying this. Hey, you know what? F everything. Let's just own the Mag 7. Amazon fell 50%. So did Google. NVIDIA was down 70%. And so was Meta, down 75%. Netflix down 75%.
Crushed.
Yeah.
Like how quickly we forget.
So some of the outperformance is because things went down less. Because I don't remember small caps having a great year in 2022.
They were not down nearly as much as the mega cap tech stocks were.
Do you think that do you think that clients or investors even look at what did the Russell 2000 do at the end of a year like this last year, or they just care about how their portfolio did?
First, they look at the Mag 7 and what it did for them. They're not focused on what didn't work. They're focused on what did work.
I
and they're
agree
like,
with that.
hey, why don't we have more like literally calls? Why don't we have more NASDAQ? A few calls for why mid caps at all? Sure, that's there.
Yeah.
I think that's and then the second point.
So the NASDAQ's compounding at like 20% a year or something. And when you build a financial plan for clients, like you don't ever build a plan that requires 20%. No. So what that means is after 3 years of that, after 5-7 years, more than once, you're going back to that family. Yeah. And you're saying, good news, we are way ahead of where we originally projected we'd be. Mm-hmm. Thank Tim Cook and Sundar and Zuckerberg. But we have to make a decision. Are we going to roll the dice into next year, or are we going to change the plan, or what are we going to do? Because
what do most people say?
I couldn't guess firsthand. My guess is that people a little bit up their spending plan and a little bit dial down the risk. And it's something in between rather than one or the other. I don't know. You would know better than I do.
With a client getting that much closer to retirement, let's say, and they were chilling 70-30, right? They love the idea of like, hey, 60-40, it's at 10% shaving of equity. Let's go back a little bit, and everyone feels good about that.
Also, I'm gonna buy a second home. Or 10 years ahead of when I thought I could.
I think they'll start talking about those intermediate term goals with a little bit more desire for them. But I think when you start having more detailed conversations around it, they'll come to the conclusion this is either a really bad idea.
You think
or a good
roughly
idea.
The same kind of thing?
Yeah, I think
people are more likely to dial back the risk than they are to up their spending.
I think stocks have given investors a gift over the last, 10 plus years. And now that bond yields are getting 5% plus, like the ability to dial it down and still be okay is a beautiful thing.
Yeah, I will say this though: younger investors, my youngest investors are, your 30-somethings. They're like, can we add? They're the ones who are saying, can we add more growth in NASDAQ to
leverage
the portfolio?
Well, shouldn't they?
After having already done it.
Yeah.
And I'm like, that 10% NASDAQ sleeve on top of your 35% in the S&P 500 might be good enough as far as risk on goes. Plus the fart corn sleeve. So,
Yeah.
You want to diversify. Julie, you have this great graphic with presidential volatility. So the Trump regime 2 start. When is that? 20th?
Monday, yeah.
What's today?
Today is
the 9th.
So it's a week from Monday. A week from Monday.
Yeah, a week from Monday. Exactly.
Okay. So you say, despite all of the tweets and crazy things, the volatility of Trump 1.0 was pretty muted.
Yeah.
Let's put this graphic up, John.
So I looked at the VIX, but then I thought, okay, well, maybe like individual stocks were more moved by his tweets, right? When he would tweet about something specific, a specific sector. So I looked at the VIX EQ, which is single stock volatility also. But both of them, and I looked at it starting the day after the election rather than waiting for Inauguration Day, because that's when the reaction started in stocks. And so the VIX averaged about 17.7 in that period of election day to election day in Trump 1.0.
Yeah.
And it averaged 19.7 under Biden. And you might say, oh, but it was the pandemic. Well, the pandemic, of course, started when Trump was still in office. And so you saw that spike in volatility.
Yeah, he had the vol spike in his presidency.
Exactly.
Biden didn't.
So even with that vol spike, the average volatility was still lower in the first Trump term than under Biden.
2017 was the calmest year ever.
Yeah.
That was crazy. It was eerie.
But not like, there's such a disconnect, right? Because the news cycle was not calm, right? He was not calm. He was not quiet. And so, it's just, I guess, a good reminder, like, not to be reactive to his commentary on fiscal, the press conferences where he talks about Greenland and Panama Canal and whatever else. The other side of that is that if you put the S&P 500 on here, it actually did better under Biden than under Trump.
We're going to react. We're not going to react to Greenland and Panama, but we're going to react to
tariffs.
I think the deportation stuff happens before the tariff stuff. And I think it's going to be fairly disruptive in cities. And I think you're going to start hearing from Chamber of Commerce types, people that ordinarily would be Republican, making a lot of noise in op-ed pages like, do not rip my employees out of the country.
But I don't think that's going to impact the market at all.
So, all right, I'll take the other side. I don't know how to quantify it, but I think that's going to be the first time Trump stuff actually hits the market. So everyone understands what's going on this week has literally nothing to do with Panama. It's about getting this guy Hegseth pushed through and ending all of the disputes around some of the people that he's nominated to cabinet positions. If he has people chasing their tail talking about the Gulf of Mexico, then that means the operatives in government have the cover to just kind of like push these things through and make it so people stop talking about them. Everyone like who's been in Washington for the first Trump administration understands that's how it works. The markets are ignoring it because the markets are smart. I don't think the markets are going to ignore the roundups if and when those happen. I think that'll probably be the first time that people say, oh, wait a minute. He wasn't just giving speeches at rallies, like he's actually going to do this.
Yeah, he's the wild card guy, right? And
yeah,
we've grown accustomed to him saying wild card things that don't actually materialize. And to your point about like I don't know what data point to other than what my guts, but like things kind of seem like there's going to be a lot more action than speak.
It's every president. The first year they get in, they start doing things.
Yeah,
like so he's going to do things, and some of them will be good, some of them will be not so good, but I do think we're going to get a little bit more volatility in Q1 than we've seen so far.
That's
since
what
the election.
Is so many opportunities for that increased fall, like right now.
Yeah. So if you're underinvested, maybe.
So how you playing it?
Yeah, Doug. What's the go-to move?
Investing in the Northwest Passage, right? So if we take Canada and Greenland, and ice is receding.
If the canal is blocked, where do you go?
Oh man!
So Doug, you talk to a lot of people, not just clients, but you're a social butterfly of sorts. How are anecdotally
Michael called you a butterfly of
It's
sorts?
not the first time.
What's going on with employment? People good?
Generally speaking, yeah. I from a wide array of sectors and industries that our clients make up. It's been few and far between. There's been a handful of job loss throughout 2024. I can't really count on too many people who didn't recover from that. I had some folks take some exit packages, and now they're doing that beautiful double dip of they still got their package and they're able to be picked back up but at the big companies like Meta, like cool, I'll leave, a huge telecom and go do brand strategy for Meta. So I saw that, look, it's taking a month longer.
To get rehired?
To get rehired than it was just a year ago. It was like 6 months. Now it's 7. I would agree.
It was 5 minutes 3 years ago.
Yeah, you can get a job if you wanted it. Now it is getting longer. I think that's pretty normal if you ask me, for the point you made of how fast it was.
Yeah.
But I think also there's been a lot of a reality check with what people get paid, right? So if you go to the software engineering side of things, right, we no longer see here's your $180,000 to be the entry level software. You're going to get $135,000 for that. And we'll bring you back in for it.
Wall Street Journal did a piece this week. Unemployed office workers are having a harder time finding new jobs. More than 1.6 million unemployed workers have been job hunting for at least 6 months. Put this chart up.
That's a lot.
So you can see this is material. This is not bumping along the bottom anymore. I don't have a chart that goes back longer than this. My gut instinct is that this doesn't stop here. Julie, what do you think?
I mean, listen, like I see.
This is U.S. workers unemployed at least 27 weeks.
I mean, listen, my social butterflyness is within the media industry, which
well, that's a whole other.
Forget about it.
Yeah.
You might as well be a coal miner.
Yeah,
okay.
Basically.
Yeah.
Don't rub it in. But does it go? I don't know, or does it just go back to so-called normal levels? Right, like
right now, that's where it is.
Yeah.
the experience of the last 3 years is not normal. This might be what normal levels are.
Right.
Yeah,
That's
I
what
agree
I
with you.
mean. Like it either hovers around here or maybe goes up a little bit. But I mean, my gut says I don't know that it gets enormously worse.
Yeah. Here's the journal. As of November, more than 7 million Americans were unemployed. More than 1.6 million of those jobless workers have been job hunting for half a year. The number of people searching for that long is up more than 50% since the end of 2022. But again, the end of
Abnormally
2022 is not normal.
Well, but there's maybe one more wild card we should mention, which is AI, right? Like,
Yeah.
over the past year, there were all these executives who were saying, "Oh, it's not going to take your job; it'll help you.
You know what's
It'll
actually
help
going to
you
do?
your job better."
I think it will. You know what they're going to do with AI, though? They're not going to do, I don't think they're going to do mass layoffs. I think it'll be the attrition.
Right.
They'll just let people gradually retire and not replace them.
Yes.
And that takes a really long time for people to really process that that's what's happening. But I could picture that scenario.
And if you're observing that happening over a long period of time, it provides the opportunity to reskill. Or if you're in college and you're like, oh, what am I going to go? Don't go into the job that's not hiring for the last 6 years in that particular position because
Yeah.
AI took it over. So you major in something else or find a different skill that is applicable.
That's
to
a
the
better
labor.
version than we're cutting 10% of our workforce permanently thanks to AI. I don't know that anyone wants to announce that, even if it's true.
Well, Klarna, the
They
buy now
wanted
pay
to say
later.
that.
Yeah.
Yes.
We interviewed the CEO last month, and he said we are not recruiting anyone anymore. Like we're just not recruiting. Full
Ever.
stop.
Ever.
I mean, for now, certainly for now, they're happy with the headcount they have, which they cut after their valuation went down. But then they did replace a bunch of people with AI,
Yeah.
and those jobs are
I
not.
think he's the
coming
most
back.
vocal that I've heard, specifically coming out and saying, we've already seen the change.
I think it's probably happening other places. It's just not being talked about as much.
Yeah.
Are you seeing it at all in your world?
I'm not seeing replacement yet, right?
You know what I'm
I mean,
saying?
and I gotta say, like, I don't know, how do you guys feel when you're going to read an article
That's
and
what
they
I was
have
about
the
to say, I
AI
hate it.
summary at the top? Or like, I don't like
I've
it
never
either.
clicked it.
No. I don't like the articles that are AI
that are
generated.
written by AI,
I'm not gonna say anyone's name, but there are certain publishers, like you click it once, click it twice, see it the third time, you're like, oh, software wrote this.
Right.
Which means there's no color, there's no context. It's like it's like this cookie cutter thing that they just changed the numbers.
Right.
And maybe that's valuable to people. I don't find any value in it. When I read something, I kind of like the author to weigh in with an opinion, and there's not going to be any real opinion in there.
Right.
So, but I get it. It's a really fast way to churn out content if that's the game that you're in. The mood is going to shift, though, here if this keeps going. In a survey of consumers by the Conference Board in December, 37% said jobs were plentiful. For context, in 2022, 57% said jobs were plentiful. So this is not necessarily people that can't find a job. This is people hearing from family members and friends that they're struggling, which again, maybe is normalized. It's just something that we haven't really heard for a couple of years. So that's kind of where we are. We have a jobs report tomorrow.
Mm-hmm.
Doug, you got something on this?
Yeah, I think it's more
What's
just
the number going to be?
I hope whatever it is, I hope it extends.
You just want everyone to have fun.
I want everyone to make money and have fun.
Yeah,
I want
I totally agree with you.
good times. Why would I want anything other than that? But I would tell you this, when it comes to people who are currently employed, one thing that I've gotten in the habit over the last several quarters is telling clients and people, like, if you're happy where you are right now, this is the perfect time to go out and see what else is out there. Call your recruiter, talk to your former bosses and colleagues. I don't think there's ever a bad time to be seeing what your talent is worth, how much pay you could get, because when things do shift, right, that's when everybody's doing that, and it's exponentially more difficult.
There's less opportunity.
Yeah, now is where there's the opportunity. So for anyone listening to this who's happy, don't sit on your hands. Look, you more than likely will end up staying right where you are, but you'll feel that much better knowing what was out there and what your worth is. And best case scenario, you find something killer.
Yeah, Duncan, John, you could ignore everything that he just said.
You guys should stay here though.
Okay, cutting government workers is a wild card here too. This is a huge part of the job growth over especially at the state level. If this Doge stuff is going to become a reality, we're going to be having a different conversation.
Where
a
are
year
all
from
those
now.
people going to go?
Yeah.
What are they going to do
Greenland.
for job? I mean,
I don't know.
Fishermen? I don't know.
No, I don't know either, but it's a huge part of what we need to remain intact. So if these plans to cut government spending are serious, at a certain point, someone's going to have to get fired. Otherwise, it's just talk.
Right.
Because that's where the money goes.
If the Doge thing happens, the amount of short-term pain and volatility will be breathtaking, I think. And you cross your fingers that it leads to that long-term payoff, like, quote, something Argentina,
Okay, here's another wild card. Your employer tells you, we need you here 5 days a week.
Oh, yeah.
How does that change the calculus on the job that you're in or whether or not you want to keep it? JP Morgan is discussing a plan to require all of the bank's 300,000 employees to return to the office 5 days a week. There are a lot of firms doing this, but they're mostly Wall Street firms.
Yeah.
Mostly banks. I think because they pay the most for the most part, they have more power to be able to exert on their labor force.
What if they're trying to shrink their labor force?
That was what I wanted to ask you.
Yes.
Or maybe they want people to quit and it's cheaper than letting them go.
Exactly.
That's 100% it. I'm glad we're talking about it because I don't think it gets talked about nearly enough. So you have number one, like the managing the hybrid remote work for very large companies like a JP Morgan with 300 is first of all, it's difficult to begin with. At 300,000 people, this is probably downright impossible. For a 5-person firm, yeah, of course, you can make that happen too. This is clearly, in my mind, more of a financial forward decision that it's clearly not a people forward decision, right?
Yeah.
You get this opportunities like it's giving McKinsey and consulting, vibes here. So you find the employees who are maybe phoning it in, kind of sitting back at home, and they're going to quit. And
those are the people that this is a deal breaker for.
Yes.
The people that are the least engaged.
Correct. Where it sucks, though, let's go the other side. So I get that. That's where the money, financial function outweighs, the headline. But where this really does suck, and this is the minority of people, is the family of hardworking, professionals who radically changed their lives during COVID, moved 2 hours away. They've demonstrated their ability to work hard while being at home, raising families and kids. And they've reshaped their entire life and they're being called.
And now you're going to yank it away from them.
Yeah, let's be honest. That is horrible, but it is, dwarfed by basically everything else we just said.
Do you think companies should say, this is our policy for people with children under 10, and this is our policy for everyone else?
Oh, yeah, that'll be popular.
I mean, that's tricky. I do think sometimes when they come out and say this, there is a little bit of wiggle room, even though on the surface it doesn't sound like there's wiggle room. I mean, when they first came back with 3 days a week, it wasn't really 3 days a week for some of these firms. So I don't know this latest one, how much wiggle room there really is. But yeah, it's really tricky if you would say, what if I don't have small kids, but I have elderly parents?
Is that even legal?
No, it's totally
Right.
illegal. But you could kind of make that small businesses are making this an unwritten policy. Like, he's got 2 kids, he's helping his wife. Shut up. That's happening. I know for a fact it's happening.
Exceptions will be made.
Exceptions will be made. JP Morgan can't do that. Even if they wanted to, which they definitely don't. You can't tell one employee that their expectations are different from someone else's based on their home situation.
But it happens. But it does happen.
I know. You can't
right?
write it down.
Yeah, right. That's what I'm saying, yeah.
Where legality meets fairness in terms of what we can talk about here. Like, you're 22, fresh out of college, get your butt into the office, surround yourself with people, learn from them, because guess who's there? The 68-year-old who doesn't want to go home and be with, his family's all grown up and is escaping their spouse, being in the corner office. They might actually have a lot to teach you if they're even willing to talk to you. But the middle there, the family, like the exception, what do we do there? That's a real issue.
I'll give you a bigger one. There are certain roles at companies where being in person is way more important than not. And can you make a different policy for different types of employees at the same corporation? It's real. I know that's happening too.
Yeah.
Like, these are the software guys. I don't care where they are. You're in sales. I want to see you.
Will we see case law in labor law, around this over the next 10 years? So, hey, for all the labor attorneys out there, it's time to shine. Here's where your billable hours might be.
Wouldn't you think less of somebody who's 23 years old and they want to sit in an apartment, like by choice? I kind of do.
How do you advance your career if you're by yourself?
Really
depends. What do you think you're going to learn sitting in your house? First of all, what's wrong with you? Why would you rather sit in an apartment than be with your coworkers? Second of all, how do you think you're going to get better at this?
Really depends on the job, because we could go through the list of things where like you could be traveling the world, doing your job, interacting with people.
But that's your job, traveling the world.
Well, no, I'm saying you're doing that for fun because you can do your job remotely.
Yeah, but how does your senior, your superior recognize your talent if you're behind a screen all day? How would they even know the quality of your work?
It depends on what your work is.
And not just the work, but it's more than just the quality of your work. It's your personality.
No, I think you're throwing the baby out with the bathwater to think you can't create managerial systems that can accurately reflect how.
We do. More of our employees are remote than here.
No. I mean, the proverbial you, right? Like an organ. JP Morgan at 300,000 people.
Impossible.
That was my point. Yeah, of course. That you got to put down the blanket policy here. But I think in a world where push came to shove, if they really wanted to, with the money and power that they have, don't lie to me and look in my face and say they couldn't figure it out. It's really hard. It's not worth the money. At least that's what they think. But there's probably a lot of people that say, here's a model, and it shows how over the long term, shareholder value goes up by treating your people in a certain way.
Yeah.
And then they can all argue over whether that's true or not. And they'll probably still say, nope, too hard, don't want to invest it for whatever reason, like come in the office. And that's how you get a result like that.
When was the last time you passed JP Morgan's new headquarters building on Park Avenue?
It's been a long time.
Oh, you haven't seen it recently?
No.
John, can you get a picture? Can you get a picture up of this? It's nearing completion.
That whole area is insane.
This will be, I think, the tallest office building in New York. It's called the Super Tall. That's the class of building it is.
Super tall.
It is the entire square block, I think 47th to 48th Street, Madison to Park.
So they got to justify that expense and have everybody in the office.
Fun fact, it was a Modell's before.
Gotta go to Moe's.
No, one Vanderbilt was a Modell's.
That was one Vanderbilt.
Yeah. All right. Anyway, if we could find, I don't know, can you find the facade of this thing?
There it is.
Tell me what you see, and I won't point it out until you find it.
Oh, now I feel like I'm going to fail this test.
When you look at the facade of this building, what do you say?
The Fortress of Solitude? I don't know.
I see a bar chart right now.
Okay, guys, in case the subtlety is lost on you, those are diamonds. They wrapped the building.
They're rhombuses.
No. They're literal diamonds. Up, all the way up to the top and all the way down, I think on two sides of this thing.
Those are quadrilaterals.
They are not quadrilaterals, sir. I submit to you. They are, come on.
That's better.
Okay.
Are these not diamonds?
He pulled up a bad resolution.
Am I hallucinating? Okay. Jamie Dimon is the boss of all bosses for that. I mean, that's not subtle.
There's his legacy, right?
So he needs everybody to come into the office every single day.
So if you just built that, you kind of want people to be.
He could have given every employee a diamond instead of building the diamond.
I don't know. I don't know why, but I feel like maybe I'm just stereotyping. I feel like if you're a new employee at JP Morgan versus a new employee at Meta and you're if you're a programmer, maybe you're not as motivated to go in.
Yeah.
But if you're like a first-year investment banker, you're going to want to be there, right?
Well, they have no choice. That's a 90-hour a week
but I
job.
guess what I'm saying is, it like when you guys, what do you think of a 23-year-old who wants to just sit it? Like it does depend on the job, right?
Yeah.
So I have an IT, just at a client meeting, IT systems administrator for a large consulting firm. Left, hired by JP Morgan, and he's going from 5 days a week all day week at home to.
What's his first and last name?
Won't be revealing that. 4 to 5 days a week in office.
How many days a week?
That.
And he's fine with that. And he said a lot of people he's worked with throughout his career are at JPM, so he's going to get to go in and see some friends.
Yeah.
How about that?
I think that's important for like your mind.
Yeah. His kids are also grown up.
You need to see people.
I like being in the office. I'm in the office every day. I mean, I have to be.
Are you every day?
Every day.
Okay. Cliff, how many days does Doug make you go somewhere? 0? Okay. Do you want to go somewhere though?
No, I like our setup.
He's happy? All right.
We got an office.
Your remote employee is happy. I have more remote employees than in-person employees. I believe in remote work.
I used to tease him, when are you going to come in the city and do all the fun stuff? And he was like, it's chill out here. I'm like, you do what you want to do, man.
Yeah.
John, chart 6 is a segue to the next conversation. So we're looking at a chart from Torsten Slock showing the total employment in U.S. commercial banks standing at 1.4 million versus Apollo, Blackstone, KKR, and Carlyle, which is one sliver. I can't do the math off the top of my head.
16,000.
16,300 compared to 1.4 million.
That's pretty crazy. Because these are gigantic market cap companies now.
Gigantic. And a bit of an apples and oranges comparison, but there is definitely a convergence between the function of the giant banks and how they're interacting with the economy and the way that these giant institutions. So where that leads us to are they're coming for your retirement plan. Mm-hmm. And I think in theory, this is a decent idea. I've heard much worse. Matching long duration capital with long duration assets. In practice and implementation, I'm a little bit worried.
I think I would agree with that. I mean, I think you guys talk to individual investors all the time. Like they want a piece of this stuff, don't they?
Yeah.
Well, if they look at the past returns, definitely. And if we're saying one of the benefits to these investments, there's this illiquidity premium. You earn a higher return because you're giving up liquidity. The 401k is the definition of illiquidity. You can't pull the money out anyway. Or you can, you pay a huge penalty so nobody does. You could borrow against it, but like that's pretty much it. So when you think about it from that standpoint, if there is a way to do private equity as a retail investor, arguably the smartest place to do it is in your least liquid pool of capital, which is your 401k. So I don't hate it.
So characteristics and time horizon, especially for younger investors, lines up to that. But I think who is this really for? I think is the bigger question. I'll take the classic like advisor line here. It's hard enough to get people contributing and investing in their 401ks in the first place. Like we live in the 401k is now the de facto retirement savings vehicle for Joe Schmo and everybody else. So if we're struggling to get them into the fund, the qualified default investment option is only 20 years old, right? That was 2006. Thank God it was. A lot of lawsuits over just sitting in cash. But now we want like PE in there. We just want people to stay invested. Like, can we get the foundational component first before we're saying, oh, by the way,
it doesn't matter what
in
we
the
want.
Lineup.
They're coming.
Yeah, exactly.
So this is from the FT. The private equity industry is preparing to lobby the incoming Donald Trump administration to give it access to broad pools of capital it has not historically been allowed to tap, including retirement savings, in a move that could unlock trillions of dollars for their firms. The $13 trillion industry is hoping the new White House will revive a deregulatory push. So they probably will. It's coming.
Oh, it's an amazing distribution channel for these shops, and they'll make a lot of money by getting their products.
Does the financial media know how to talk about private equity yet?
Well, that's a good question. They're talking to us more than they ever have before. I'll say that.
Middle market lending.
Yeah, I mean,
they are.
That's been a real change since the beginning of my career. I mean, they didn't used to want to talk to the press at all.
Because Yahoo Finance is geared toward investors that they've never talked to before. So you guys are actually a great outlet for them to start getting normal people accustomed to the particular jargon within PE and private credit that none of them have ever heard before.
Well, and here's where I do my disclaimer. Yahoo Finance is owned by a private equity entity.
Of course.
Apollo.
Of course.
So Torsten Slok.
Of course.
Your colleague.
Chart favorite. And one of his frequent charts that I love is the one that shows how many public companies there are now compared to 10 years or 20 years ago or whatever it is. And it's shrunk, right? That there just aren't as many publicly traded companies anymore.
So the caveat is there were too many publicly traded companies in the 90s. A lot of them were real pieces of shit. But the other corollary to that is that Torsten Slok also has a stat showing that 87% of all companies in the United States with $100 million in revenue are privately held.
Right.
And so why shouldn't investors be able to access it? And I think they should and they will. The question is, what are the fees? Which I think they're going to come down dramatically, by the way. I think this is on balance a good thing. This will push fees lower because competition and more distribution. But the diligence part, like what is the individual investor even supposed to be looking at?
What do they get? What are they getting?
What are they getting?
What is it?
All of it.
No, but like even like investors are going to have to learn about like IRRs and different ways of looking at the return. They're going to have to learn about all these different fee structures that are inherent to PE that is not relevant when they look at a 40 Act mutual fund. So that's going to be the job of the financial media to communicate, yes, this is different from other investments you've made, and here's how it's different.
Yeah, I mean, in answer to your original question, no, I don't think we know yet how entirely to talk about it. I mean, we were mostly talking about private equity here, but private credit is on the table too. And to me, that could be as big or bigger.
More,
and that's more opaque and more complicated, I think, to explain to people So that also, I mean, even just talking about the corporate bond market, people is tough enough without throwing private credit in the mix. So that's also going to be a challenge.
If you talk to any PE CEO right now and ask what's your priority for 2025, right? So 20 years ago in 2005, they would have said China, okay? I think 10 years ago in 2015, they probably would have been talking about LBOs in the stock market, right? Like valuations were cheap in small cap. Now it's just wealth. That's it. That's the whole ball game. You got $7 trillion at RIAs, probably another $10 trillion at the wirehouses. God knows how much at family offices. That's it. This is it. We want to talk to wealth management.
I don't think, so let me just push back against this a little bit. I don't know how I'm pushing back against, but I'll just throw this out there. So when people invest in their 401k and they're at a target date fund or they're in stocks and they're in bonds, do they really know, do people really know what bonds are? Like, here's my treasuries, my corporates, my agency back. Like, no, people don't know. And I think that over time, private credit will be viewed as it's debt. It's not a bond that trades on the exchange or anything like that. It's not frequently traded, but it's a loan to a company.
So throw it in under the alts umbrella, right?
No, it's fixed.
No,
so they do that now, but I think if you just call it fixed income.
It will be indistinguishable from fixed income in a few years.
That's what you're saying, which is where we're going.
Yeah.
So what's the allocation in your, 401k
what if, all right,
to,
so what if I say I'm setting up a 401k for an investor who's 30 years old. I'm helping a 30-year-old investor with their 401k allocation. Now, of course, it's not how it really works. What actually happens is your HR person says, here's your password. You log in. There's 600 funds to choose from. You have no idea what any of these terms mean at all.
Sure.
You end up with a portfolio that's 40% Korean. And
well, hold on. Don't discount the portals that now will be like, hey, we'll invest for you, and you fill out a questionnaire.
Correct.
And I think
or you just choose the default,
or the target date fund. But what an opportunity if we're going to really dive into the distribution strategy of PE firms. Like, you want to get in the allocation models that 100%. Are promoted by the plan administrator.
Well, it's coming. It's inevitable.
That's to me,
they'll get in those.
If you can auto into it, oh my God, that's just free inflows for days, right?
So somebody who's 30 years old, is it feasible that we can see them be in a situation where it's a 70-30 portfolio, and of the 30 portion that's fixed income, 20 of that is high grade corporates and treasuries, and 10 of that is some sort of a private credit fund.
The AGG with,
I think that can happen.
It's coming.
PE.
Yeah, I'm highly confident that's coming.
The fund company that figures out how to bundle those things so that it's just one ticker, in my opinion, wins. I think that's where BlackRock is going.
Do it.
Yeah. But does this then, if it's going to happen there, does this then proliferate it showing up into allocated funds and into your single fund solutions held in brokerage accounts?
They're making a massive push. Listen to any of the earnings calls, and they keep saying that we think credit is credit. It doesn't matter if it's private or if it's public. The wrapper matters, but it's going to be indistinguishable from one versus the other.
And the feature, it pays a yield. Yeah. Like, that's what we're doing. Yeah. We're paying a yield.
So now in terms of education, I was talking to one of these companies today, and they're like, listen, it's pretty simple. It's SOFR plus 600 and 1 turn of debt. I'm like, yeah, but dude, slow down. Nobody knows what you're talking about. So even if I said, I like you, I like the team, I know what you guys are doing, what am I looking at in terms of diligence? I mean, you going to show me the sub-documents or the covenants that, I don't know what I'm looking at. Okay, great. This company's doing $130 million in EBITDA. We're making them a loan. Great. Okay, I guess that works. Sure, why not?
But this was your point about bonds, when you said, oh, do they even know what a bond is, right?
No,
but brand name is going to matter here. So if you're an intermediary, if you're involved with the plan sponsor and you're picking the menu of funds, brands are going to matter a lot. Mm-hmm. And saying Apollo or KKR is going to be important so that you don't have to talk about due diligence.
Do you also get to say, like you do with bonds, which they would know, hey, we put bonds in our portfolio to dampen volatility. It's our less risky asset.
No, you'll have
Are you going to get to say that as well when you start?
Yeah, there's no volatility.
Negative volatility.
Nothing ever moves. You're gonna have to couch this in the language that you use when you talk about high yield bonds.
Yeah,
because that's what it is.
My point is, it's Thanos.
It's happening.
Like, it's coming. Yeah.
I would guess that's probably directionally right. I don't know if it's this year, but
all right, Doug, you'll have some takes on this. There was an article in the Barron's, I think 2 weeks ago, talking about how Americans are binge shopping and we're addicted to spending, and it's so much easier now than ever to spend, whether it's Instagram or TikTok, whatever. Let me set this up with some data. Americans are expected to spend as much as $5.28 trillion at stores in 2024. We've got a chart showing the consumer spending as a percentage of U.S. GDP. And this is like really where it stops and starts for me in terms of like the whole economic story that we're talking about. Like a lot of times we're talking about things that are noisy, like the 10-year term premium. Like this is it. This is it.
line go up.
Line go up.
People spend, right? We've, in the notes here, it's so frictionless. It is so beyond easy to purchase stuff.
Scroll your phone and buy things.
Oh my God, I get trapped into like this Simpsons shirt's so dope on Instagram.
How much do you return how many things that you order on your phone do you end up returning?
Amazon's the only place where I feel comfortable. All the stuff that you order off my phone or Instagram, I wouldn't even know how to return to like where these, like sometimes they come from the UK. I don't even know where they're coming from half the time.
Yeah.
And that's not going back unless you're paying like $40 for shipping. And you got to love it when you leave something in your cart and you get like 5 emails saying, or text saying, hey, you left something behind.
Your doorbell rings.
Yeah.
See, that makes me annoyed and I just don't want to buy it then.
Yeah, same here.
That'll turn you off completely.
I don't like the hard sell. So I get annoyed and then I don't buy
Put
as
this
much.
next table up, John, if you would. So, Doug, to your point,
There you go.
percentage of respondents citing the platform as fueling their shopping addiction. This is 12 to 43-year-olds. 78% blame Amazon. 15% blame Instagram. This surprised me. 46% YouTube.
Yeah, I didn't know that was a thing.
TikTok is almost neck and neck with YouTube at 44%.
Wow.
And then there's pretty much everything
TikTok,
else.
it's all affiliate marketing, which they think is going to hit $16 billion by 2028. It's a lot of money.
Affiliate marketing. So it's an influencer who has a deal with a cosmetics company. She sits on the camera, does a full face of makeup, and there's a link that you can buy whatever products you just used.
Oh, it's real.
And then buy now, pay later is
Yes,
gasoline on
definitely.
this.
Yes.
I watched
it's
Heather put on
definitely-
a story like things, she's sending to camp with our daughter, and you can click these things. And I think like she's like, hey, we made $90 because like it works. It's not our job, but like it actually happens there. But the part of all of this, I think that is the extra bit of toxicity, or what makes it radioactive is probably the buy now, pay later, programs that get wrapped up into this. Specifically,
That's better than having a balance on a credit card?
I think it's worse. I think it teaches I think it makes a bad habit here. I worry about the younger generations because it reinforces bad spending behavior, and I think it reinforces debt accumulation. So
Because it's easier?
because they think they can spread it out. I think you're likely to forget it. It makes you believe that I can have this today instead of actually coming up with the capital to buy it. The use of buy now, pay later as a credit option allows shoppers to split into multiple payments. It rose 9.6% year over year and contributed to $18.2 billion in online spending during the holiday period. It's an all-time high for the holiday seasons. This is according to Adobe, and Cyber Monday was the biggest day on record for buy now, pay later.
Yeah, but Doug, do you
with
want your
1
stocks to go
billion.
up or not?
I think
Of course I do.
I
but
think that a firm would say the alternative to this is not people paying in cash. It's people using a MasterCard
At
Yes,
20%.
and then
Yes.
having that
Yes.
balance follow them around for the rest of their lives.
Well, and not only that, these guys will also say that their default rates are low. The people don't forget it. They actually do pay it
And
back.
they are low.
That's the argument that
Statistically,
I get it.
But we've only seen these proliferate so far in a good economy.
We don't have bad economies.
We don't do that anymore.
You see the spending?
We don't know what this looks like in in a recession.
The bigger macro issue around all of this is that we're conflating consumption with happiness. And if you fall into that trap, you're just going to end up trying to fill a bottomless hole that, will never be filled and end with disappointment.
Speaking of bottomless hole,
The more you know.
I don't want to hear the end of that.
That was like a
sentence.
Jerry Springer at the end of the
Guys,
Jerry Springer episode.
The final thought?
Yeah. Final thought. There we
Yeah,
go.
yeah.
couple other things happened this week.
Take care of yourself,
worth noting. We've had this kind of mini bubble, kind of sideshow bubble in quantum computing. So Alphabet came out and made an announcement about achieving
Willow
quantum computing dominance or whatever, and everyone got excited. And there were 3 or 4, I'd call them microcap stocks, that all of a sudden exploded and became meme stocks because They're involved in quantum computing. It's a kind of a mini bubble because they're still tiny, but these were the stocks that active traders / gamblers were talking about. Jensen Huang was asked about NVIDIA's strategy for quantum computing, and he said,
Number go down.
he said,
No.
getting very useful quantum computers to market could take 15 to 30 years. And then John put that chart up. This is what happened.
No.
Qubit Quantum Computing Inc. fell 50%. This is on the day.
One day.
Rigetti, I shouldn't be laughing. Rigetti Computing fell 49%. What is it? IONQ fell
Ionic?
46%.
Ionic.
And QBTS, which is D-Wave Quantum, fell 48%.
That's my favorite play.
You like the D-Wave? Okay.
Jensen, the godfather of
And
AI.
then the D-Wave CEO was like, Jensen Huang is dead wrong about quantum computers. Well, I trust D-Wave more than Jensen. Anyway, it's crazy to have a stock get cut in half
In a
because
day.
some other CEO in an unrelated industry makes an offhanded remark like that. So as much as we're in a casino with very swift enforcement.
There are rules.
There are actual rules to this thing where it's not like these stocks were able to just like pretend that didn't happen, or the owners of these stocks were able to pretend that didn't happen. Have you had any quantum people on the show yet, or any analysts talking about this stuff?
A little bit. We had some people talking about it a little bit when the alphabet thing happened. The picture of the like steampunk looking device that was actually a quantum
like a
computer.
chandelier,
I know.
right?
I was
It's kinda cool.
I said it's a golden octopus, but chandelier
Yeah,
works too.
yeah.
What device are you guys talking about?
The
The
quantum
quantum
Willow.
computer
I
that
showed it to
Google
you.
made.
Okay.
I showed it to you.
And they also had the quantum computing chip separately. The Willow is their
the
quantum chip, right?
Mhm.
So we did have some people talking about it, and they said at the time, but they're not Jensen Huang, but they said at the time, this is not happening right now. This
Yeah.
is like a years down the road thing. But
He said 30 years.
he said 20 was the most realistic. He said it's not 15, but it's probably not 30. It's probably 20.
Okay,
If you
we'll all
told
be
me
dead
that,
by
I would
then.
believe.
It's useless.
But like,
Nobody needs it then. I want it now, Daddy.
well, you can't have it now.
Yeah.
But you can have robots, and you can have,
Fine, I'll
all
take
the
the
other
robots.
stuff.
What is quantum computing?
I heard a
even?
lot of chatter specifically from, believe it or not, the Bitcoin community when it came to the announcement of quantum, because can it
That's
break?
their kryptonite.
Yeah, it was.
Okay, guess what? Somebody said if there's quantum computing, they're going to fucking hack the Fed. Why would they care about Bitcoin?
It took the words out of my mouth. I do not think that's at the top of the priority stack
We could
here.
solve every puzzle in the world. Let's get Bitcoin.
Let's crack the
Well,
Bitcoin blockchain.
they'll crack people's emails. They'll crack everything.
It's not the thing you're primarily worried about here. But you learned by following the Bitcoin narrative. You actually learned a lot about this quantitative computing.
Oh yeah,
thing.
let's hear it.
No, we just talked about it. That's their fear, and then people were debating as to why.
Okay.
Mike.
These are computers that are more powerful because they're not stuck in this 0 or 1 binary coding thing.
It's middle out.
Zeros and ones. It's middle out compression. Zeros and ones
middle
can
out.
become ones and zeros. Is
And can't they also run all of it at once?
At once, yeah.
correct.
Yeah.
Look at you, Julie.
I know something.
Eddie Elfenbein taught me, whenever you can't answer a question, you always say, it's really technical. I don't think you would understand.
I like
Eddie's
that.
the man.
Shout to Eddie. Duncan, did you hear this Adrian Peterson thing?
Yeah, I was reading that.
Were you upset by it? Were you a fan of AP?
No, but I mean, it's sad to hear.
It's John, play this, please.
According to the USA Today, a Houston judge has ordered AP to surrender property to satisfy the debt. Constables have been ordered to seize assets from his home. A court-appointed receiver has accused Peterson of playing a shell game in order to avoid payment. Ocho. Ocho.
Who doesn't love Shannon Sharp?
AP.
I was going to let this whole thing go, but it's almost too
Bro,
too
you
funny.
made $100 million. And then he borrowed, I think he borrowed like $5 million in like 2 years, the interest. So when you borrow money like that, you got to pay like 20-25% interest, Ocho. So it went from 5 million to like 8 million in 3 years. It might be 50% interest.
All right. Shannon Sharp, ladies and gentlemen. All right. So this is a big story in sports circles because this is one of the highest paid NFL stars of recent times. probably made $100 million is broke and negative net worth at this point. A lot of bad business dealings. Had a financial advisor who he is now accusing of getting him into a loan where the interest is now worth more than the amount he borrowed. It kind of sucks because he's a future Pro Bowl for sure. One of only 6 running backs who's ever, I think, broken 2,000 yards. He's just got this list of superlatives. Had a 15-year career and nothing to show for it financially, which is pretty upsetting. I bring this up because, and Doug, I want to hear what you think.
Mm-hmm.
There's this idea that it's glamorous to be a financial advisor to pro athletes. But the more you think about it, it's not that it's bad to do that. It's great to do that, to help people. Those are really hard cases.
Very hard.
Because they make all their money in their 20s, for the most part. And that money has to last a really long time. And the amount of uncertainty around injuries and things that you just can't imagine could happen at any point. The typical wealth management client is making most of their money in their 40s and 50s and does not have that much time that they need to account for in terms of what they save. And you don't really have this sudden injury risk to the degree that a football player might. So these are not glamorous cases to work on. This is obviously a worst case scenario. What were your thoughts when you saw this?
3 main lessons, but I wanted to say it's not dissimilar from some of the YouTube stars or influencers who do particularly well when they're young and they're,
Yeah, how influential these people going to be when they're 45 years old?
They are not. I see it with DJs and entertainers just the same. They are tough cases. With athletes, however, the money scripts that they have, and I'm generalizing here, whether they grew up, not well off or, it was just kind of tough, you have that kind of creating a compound fracture.
What's a money script?
Money scripts are the observations and environments that you grew up in around money and how that plays out into your behaviors around spending and money throughout your life. So it's kind of like your money DNA.
Are people trapped in their money scripts from their childhood?
They can break them, but it's really hard depending on how severe the trauma is and what that experience is. And a lot of times, and we've interviewed a lot of people like this, they either fall victim to it and repeat the same thing that they have experienced either through their parents or whatever that was, or they go completely the other way and become
like, I grew up poor and I'm determined I'm not gonna make the same mistakes my parents made.
Right.
You hear that story a lot.
Or I grew up hungry and I'm going to now overstock my fridge with, too much food, go completely the other way and overcompensate for it. But 3 big lessons. 1, the importance of financial literacy, clearly. 2, vulnerability of exploitation by advisors and people you surround yourself with. You want to be extremely careful there as advisors.
Which is one of the allegations in this situation.
And 3, maintaining a sustainable lifestyle, which kind of dovetails into point number 1. $100 million in a muni bond fund, kicking out 3-4% tax rate.
First of all, you're giving 10% to the agent.
Yeah, okay.
Your lawyers.
So turn that 100.
50%. 50% is in taxes.
So let's turn the 100 into 50. Put a 4% tax-free coupon on it, and what do we get?
Yeah.
$2 million a year lifestyle tax-free. I mean, easy for me to say that.
Well,
right?
but your point about these are kids, right? And so if I'm a kid and
kids that
maybe
don't necessarily have people
enough.
looking out for them that know anything.
I have one more lesson. John, can you throw this up? Probably
I
don't
would encourage people to really look into the penny stocks where you paying a couple dollars, 50 cents or whatever. Within 5 or 6 months, that money will flip so fast. You'll be like, what?
All right, that's enough.
Some opportunities.
That's Adrian Peterson.
Yeah.
He was trading penny stocks. Probably shouldn't be doing that either.
Yeah, he's got like a colorful history of things he's been doing with his money and car collections, and it's a shame because you can never replace that amount of money.
No, Julie, was your point that a kid who lives 1 year at a lifestyle of $2 million is going to want more than that because that's their baseline now, or are they going to say to themselves, "Oh my God, I'm doing everything I ever wanted to do on God's green earth, and I can do this every year for as long as I live, clipping $2 million coupons"?
Well, I don't know that they would know what $2 million buys them in a year, but I could see them spending more even potentially if they if they want a certain.
I agree with that. That's the importance of the financial literacy component
Right.
and the advisors around you. If someone had simply said, "Look, I want you to spend a year living on I'm going to only give you $2 million here. Go have at the beginning of every month, I'll give you 1/12 of $2 million."
I'm sure his spending was out of control.
Out
Could
of
you
control.
imagine what
He was
his
flipping
monthly
penny
nut looked
stocks.
like?
The other thing is that when you're a young star, whether it's movies or TV or sports, there's also an expectation, and you have to have a certain outward persona.
Mhm.
You have to project success if you want to get endorsement contracts, if you want to be mentioned positively.
Yeah.
So it's not like anyone should expect people in that position to not be superstars. It's just like there's a limit, and who the hell knows what the limit is?
Ocho Cinco in that video goes on to say that AP flew out 300 guests to a birthday party that featured lions and all kinds
Now,
of
you
animals.
don't advise your clients to do that sort of thing?
For hyenas, maybe.
We can do a
Lions?
small petting zoo in a
Do you
backyard.
know how much a lion costs in 2025?
Inflation's real, Josh.
Right. I just think these are really tough cases.
Yeah,
And
they
I
are.
don't fault. I don't look at this and say, I feel genuinely bad because I don't know what you do now. How do you get that back? It's impossible.
A lot of
Not gonna-
cameos.
A lot of
You
cameos.
beat me to it. You beat me to it.
Quantum computing. All right, last thing. Kevin O'Leary is pretending he's about to buy TikTok. I'm willing to bet anybody $9 billion that in no way, shape, or form is this actually being discussed anywhere other than from Kevin O'Leary's mouth on Fox News or on Twitter.
Can I do a shameless plug?
I want you to.
Guess what? Kevin O'Leary is going to be on Yahoo Finance
Yeah, I
tomorrow
can't
morning
believe it.
talking about this very thing.
Well, here's the news. The Shark Tank star has teamed up with other entrepreneurs, including former LA Dodgers owner Frank McCourt, to lead a bid in purchasing the social media platform from Beijing. None of that's being discussed, which has been required by U.S. officials. However, O'Leary believes he needs help from President-elect Donald Trump to finish the job. This is a quote. Quote, Trump will be who we have to work with to close the deal in the months ahead, he announced during a January 6th appearance on Fox News. So I wanted to let him know, as well as others in his cabinet, that we're doing this and we're going to need their help. Do you think Kevin O'Leary is the front runner to own TikTok? Does that sound realistic?
I don't want to front run the interview tomorrow morning.
What are you going to ask him?
I'm not actually doing that. It's not
All
me
right.
doing the interview. So
All right. Do you think so?
I asked ChatGPT what the probability of Kevin O'Leary buying TikTok. And
You want to take the other side of my bet?
Nope, it says it is effectively zero.
It's effectively zero.
And
well,
then- and then I-
ChatGPT says it.
And then some sentences as to why.
Right.
But I just like the fact that it literally flat out said
All right.
effectively zero.
Wow.
I don't think there's a bandwagon he wouldn't jump on. This is the latest.
He's going to pay them a $2,000 a month royalty.
I was waiting for the Shark Tank royalty joke, and I am so happy you made it.
No, but don't you feel like in 5 years it's like O'Leary quantum computing?
I think he becomes a quantum
It's
computer.
it's like super Trumpy to just like throw your name on everything. So I don't think that's something that's gonna happen.
Did he have like O'Leary Pogs back in the 90s? Because
yeah.
probably.
Probably. All right, guys, you have fun on the show today?
Yeah.
Yeah.
All right. We loved hanging with you both. And we finish the show every week by asking our guests, what is the thing you're most looking forward to? Doug, let's start with you.
Oh, it's ladies first.
No, you go first. You've
Two
done
thi-
this
two
before.
things.
Not on this show, Doug.
Okay. Two things. One, AI playing a bigger role in our lives. We're getting cool stuff, but nothing that we go, whoa, we want the next big. So give me HAL 9000, but without wanting to kill me or do evil things.
Yeah.
Like, hey, schedule my vacation, book the hotels, and like literally it does it or presents the options to me.
You think that's coming this year? I don't.
No, not this year.
Okay.
But that's my big one. But this
Okay.
year, what's coming is helping couples become unstoppable financial teams.
Oh, look at this.
There
Doug,
it is.
Doug's plugging the book in what are you looking forward to segment.
Money together.
Would you expect anything less?
No,
Okay.
I love it.
Julie, we want to hear from you. What are you most looking forward to?
Okay, I'll do the like businessy one first, which is that I'm excited to continue to cover Elon Musk in 2025.
You haven't had enough?
I mean, do we think we're getting a cyber cab? Do we think we're getting the cheaper car?
You'll get a cyber cab by the end of the year.
You think so?
Yeah, there'll be like 2 of them on the road.
Yeah.
Uber will go to $4.
I mean, whatever I think of him, like it's a fun story to cover. And obviously, whatever happens with him and Trump will be interesting as long as it doesn't harm too many people.
I agree. That part's gonna be fun.
That's the disclaimer
When are we
part.
setting the line for like with their breakup? Is it 3 months, 6 months?
I don't know. I think it could go long. Like I feel like so many people were on the side of, oh, they're gonna have a falling out, that I would almost take the other side.
Well,
of
Musk
it.
won't fall out with Trump. Won't fall out with Musk. It'll be the opposite. Trump will be like, "You're gone. You're annoying me."
Yeah, I don't know.
Well-
I think if it hasn't happened so far, I don't know if
He's
it's
not even
going
in
to
office
happen.
yet, though.
Yeah, but I feel like he had short patience for other people. I don't know.
I'm going to give you the fault lines.
Back half,
Here they
front
are.
half.
Tell me.
Elon Musk got very animated about H-1B visas on Twitter or on X. And a lot of other Trump people did too. A lot of his new friends, the founder crowd, all the VCs and software guys that are now Trump guys, they're all pro H-1B visa because they need talented, skilled people who are building ones. All right, so that makes perfect sense. And I actually think that's good for America too. Okay, fine. So I'm not against it, but I'm just saying they were aggressively. And I thought that could have been a moment where Trump refuted all of that. And he didn't. He kind of was like, no, I agree with Elon Musk. That was interesting. Another fault line is going to be China, because the tariff stuff is going to start probably in 12 days. What did we say? Inaugurations in 10 days?
Next Monday.
Okay.
A week from Monday.
12 days from now, the China saber rattling stuff. And most of it is just going to be a prelude to Trump talking to China. And it's just, making noise. That is Elon's most important market. The Shanghai Gigafactory is extraordinarily important to Tesla, and the Chinese consumer is up for grabs. There are many Chinese EV players looking to supplant Tesla. That's another potential fault line, okay? For a lot of companies, not just for Tesla. The third and more interesting one is whatever happens with Truth Social. Part of me feels like it's obvious that Twitter just buys it, and Trump gets a really big check as a result of that. And maybe he's kind of counting on that happening. And it certainly could happen. But from my perspective, those are the three fault lines where something interesting could happen where the bromance falls apart.
Yeah, I mean, with the China one, to me, that would be the most likely one. But I could also envision a scenario where Musk is the back channel guy.
Yeah,
where
totally.
He's the one who helps broker some sort of situation that helps both sides save face. But I don't know.
I actually think that's the best outcome, is that there's some sort of trade talks.
Mm-hmm.
And I don't care if we see them in plain sight or don't. I think a worst case scenario is a repeat of 2018. And nobody had any fun in 2018.
I think Trump has sold himself on the fact that he believes Elon Musk is the smartest man in the world, and he's got him in his corner, and he is the greatest tool. I don't mean that in a bad way, but he's the greatest tool to operate things
It might turn out
he
that
could
way.
possibly have. And you're right, it might actually turn out, or get really annoyed with him and kick him out of Mar-a-Lago.
Either
find
way,
out.
Julie, I agree. That's going to be fun to watch. What's your non-financial thing that you're most looking forward to?
And this one is fresh in my mind because it was just announced. There's a band called Wolfpack.
Yeah.
Do you guys know this band?
No.
So they played 2019 at MSG, and it was like this weird thing because it was this like little band that I had heard of that didn't have, I don't know if they had a label, and they played the Garden.
You like Disco Snails?
That's like one of the side projects-ish.
My kids sing that song
Oh,
from
really?
this summer. Yeah.
Wait,
So
what
there's
is
like-
this? What is this band? Are they German?
No, they're from the University
Fine,
of
but
Michigan.
it
So it's
sounds
like
like it.
it's a play on the Wolfpack in
Yeah, yeah.
University of Michigan. And so it's Wolfpack, but then there's like the guy who was one of the guys who started the band who also puts out music as Wolfman.
Mm-hmm.
And then there's some songs that they put out just as Wolf, but it's sort of a collective.
How
that
do they
are, like,
play the Garden?
very well, I thought.
No,
'Cause I saw-
but like I've never heard of them. How do they?
Because they have enough of a following. And
Yeah.
also there are different configurations of the Garden where you don't have to do like the whole 360 situation.
How did you get put onto this band? Are you like secretly like
That's-
a cool indie rock chick?
Yeah.
Sure.
You are though.
I mean,
I like that.
I don't even remember how I first found out about them. My husband's in the music business. He's a promoter. He does more.
Oh, okay.
He does more like jam band than indie. But so
Have you been to a
that
goose?
was-
Have you been to a goose show?
I have not been to a goose show yet.
So
he's not a huge goose guy. He's sort of he's a fish guy.
So all the
So-
guys my age that are not Dave Matthews or Fish are going
Goose.
hard into
Yeah.
Goose. I'm trying. Like I'm listening to it a little bit. I'm not going to a show. These guys are going to shows with like 8 dudes. You know what I'm talking about?
And they get a party bus, right?
Yeah.
I think this band played Radio City or something. Like I think they're playing.
Goose is
bigger.
Goose has gotten pretty big. Yeah.
They're
Goose
at
is pretty
PNC
big.
at the PNC over the summer.
Did you see it?
I did. I wanted to, but
you did want to go.
I did. I'm gonna vouch for Julie with Wolfbeck. It's some funky stuff, man.
It's really good. It's really
all
good. You should check it out.
It's fun. It's good.
Billy Strings. Are we on the Billy Strings
like
train?
Billy Strings,
yes. You know, there's a lot of good music.
Billy Strings pops up in a lot of my Spotify playlists, and I'm like, oh, this
I feel
is pretty
like
cool.
that's the same like universe now. The newer kind of jam stuff.
Yeah. All right, I'm in. Well, I want to thank you guys both for being here this week. It's been an absolute pleasure.
Thank you.
Hope to have you both back, and maybe we'll see what ends up happening with all these things we're watching for. In the meantime, thank you guys so much for listening. Special thanks to John, Duncan. Duncan, welcome back, by the way. Special thanks to Cliff.
Yeah, Cliff's a man.
Can you say something about Cliff?
You know, just blessed to have Cliff in my life.
Cliff works with you at Bonafide Wealth?
Yeah.
All right.
Yeah.
And I know he's indispensable to you.
Number one, man.
All right.
Absolutely.
Cliff, we appreciate you. Thanks to Nicole, Duncan, John, Graham. Who else? Rob. The gang keeps growing. Daniel, Sean, Chart Kid, Matt. We appreciate all your help. Guys, thanks for listening. We'll see you soon.